Welcome back, everyone. Let's continue our discussion from where we have left. Until this point, we have estimated the valuation, or we have estimated the present value of all the visible FCFF. So let's understand the visible FCFF are basically the FCFF estimated for all the estimate and forecast years which we defined during the start of our financial modeling preparation. So before we continue, let's rename this file. The file name is going to be 25.finmod Britannia intrinsic value. Now let's first understand that what will be the invisible FCFF. So as we can see right now, the March FY31 has the FCFF of 5,226. Now we also have a pure confidence that the company will continue to operate beyond 2031 as well, which is 32, 33, 34, 35, and it will continue for infinite time periods as we discussed during the valuation framework video. Now, if the FCFF is been estimated for March 31, so there will be FCFF for 32, 33, 34, and so on and so forth for infinite time periods. So while we are doing the valuation of the company, valuation should include all the visible FCFF, which is basically the present value of the visible FCFF, as well as invisible FCFF. Now, what will be the invisible FCFF? Basically, these are our invisible FCFF. So these I can say are invisible FCFF. These are our invisible FCFF. Now, these all invisible FCFF will have to be discounted and first of all brought at this point. Now, which time point? That is at the end of financial year 2031. And once we have this, the same FCFF, the same discounted FCFF will have to be discounted back, and it is going to get up to the point of today's term, or basically the date of valuation. So I can say valuation date. So invisible FCFF will have to get discounted up to this point, which we can also say this is going to be the terminal value as on the specific date, and then get it discounted in this particular date, which is the valuation date. Okay, so this is what the calculation we are going to do. So let me just keep this with us while we are going to address everything. Okay, so we have got everything somewhere around row number 44 and 54. I'm going to keep this structure, and now let us go up and let's work around with the calculation of invisible FCFF. So first of all, what we are going to do is I'm going to just write PV of invisible FCFF. Let me also rename this as PV of visible FCFF. Now, this is what we are going to calculate. And for that, we will first of all calculate the terminal value. So let's select this array and change this to heading 3. What is the selection of the array? B36 to E36. And we are going to write terminal value. So terminal value. And this will be as on 31st December, December 2031. Okay. Now, why I'm writing as on 31st December 2031? Let me show you. So when we were talking about, this is the step which we are calculating. So identifying first of all the invisible FCFF and then getting that into this point. So this is what we are going to do first. Now, to handle this situation, we are going to first of all get the relevant information for us. FCFF as on 31st December 2031. Then we will require a terminal growth rate. Then we will use WACC. So we already have some elements with us. So I just use equals to WACC and press tab, press enter. Let me change this to percentage cell style. Do we have FCFF as on 31st December 2031? Yes. So either I select cell number P31, or if I select cell number P26, it's one and the same thing for us. So I'm selecting P31, and this is what FCFF we have in December 2031. Third question comes is what will be the terminal growth rate? And if you can look at the input and calculation sheet, we already have a row or cell basically, which is E24, which talks about terminal growth rate. Now, to identify what we should use as a proxy, let's look at some of the resources available in the internet. Let's look at IMF data mapper, and right now let's look at the GDP current prices. So what we can see right now, it is 4.15 thousand billions of US dollar, which is GDP of our country, which is India. So India's GDP, we can say 4.15 trillion US dollars. So that's what the GDP is. Now, but we need to know about the forecast of the GDP. Let me show you Goldman's article, which was published in July 6, 2023. It was named as how India could rise to the world's second biggest economy. When you look at the data, of course, there are a lot of details about it. And there is an interesting graph over here which we can see. So as per the report, which says that the India's GDP is going to reach somewhere around $52.5 trillion by 2075. So by looking at this particular data, we can see the GDP of India is expected to be $52.5 trillion by 2075. I can use the current year, which is 2026, and use the base as 4.15 trillion and use what is the expected GDP by 2075. So let me give you the number. So 2026, it is 4.15 trillions. 2075, it is expected it to be 52.5. What is the difference in the years? So difference is 49 years. Now to calculate the growth rate, we are going to use final value, which is 52.5 divided by initial value 4.2 and to the power of 1 upon the n, which is number of years, closing the bracket minus 1. And if I change this to percentage, we are going to get our growth rate. Now, if you look at the lot of other documents, if you can search through, you are going to find that the long-term sustainable GDP growth rate for India is somewhere around 5 to 6%. In some cases, you might also see 4.5% as well. So yes, by looking at this particular reference, this is what number which we are getting. And this could be used as a proxy for our terminal growth rate as well. So right now I'm just using this number, copying this and pasting it special as values and in number formats. And I press it OK. And here we have with the number, as you can see here, it's 31544.58. And of course, if you are not really comfortable with the growth rate, which you do not think that that is going to be the growth rate after 2031 to 2075 or for the long term, you can reduce that growth rate to maybe 5% or even if 4.75% as well. So for our model, we are going to use this growth rate. And let's use this as a proxy. I copy this, the terminal growth rate, I come to DCF and I come to this cell and I paste special as link. I change the cell style to percentage new. Now in this cell, which is B40 to cell number E40, I select this array and I change the cell style to subtotal. I hard code in cell number B40 as terminal value as on 31 March 2031. And to calculate the terminal value, we are going to use a Gordon's growth rate formula to calculate the terminal value. Here for us, the formula is going to work something like this. So FCFF for financial year 31 is going to get multiplied by 1 plus the terminal growth rate. And the denominator is going to be the WACC minus the terminal growth rate. This becomes the denominator. So I come to this cell, which is E40, I press equals to, now FCFF 2031, which is this one, multiplied by, starting the bracket, 1 plus the terminal growth rate, which is 5.3. I close the bracket, I divide this, and I close it again, which is WACC 8.8 minus, again, terminal growth rate, which is 5.3%. I close the bracket and I press enter. Here we have the terminal value as on 31st March 2031. So if we look at the framework which we were talking about, we have got the terminal value, which is this one. But still, this cannot be directly used as present value of all the invisible cash flows. Right. For that, once again, we will have to discount it and get to the valuation date, right? So that means we are going back once again and we are going to work around in this cell, which is cell number E34. E34 is equals to E40 multiplied by the discounting factor. Yeah, because we have already calculated the discounting factor to bring the future cash flow from March 31 to the valuation date. And I press enter, and here we have PV of invisible FCFF. So we have PV of visible FCFF, which is basically the total of all the present value of FCFF available for discounting. And when we talk about PV of invisible FCFF, so this is what it is linking it to. So this is coming from the discounting factor getting multiplied by the terminal value as on 31st March 2031. I hope we are clear up to this point. Let's continue to calculate the enterprise value, which basically we have already done it, and also calculate the equity value. I come to this cell, which is cell number B43, and select up to E43, change the cell style to heading 3, and I hard code enterprise value. And again, we are having PV of visible and PV of invisible. So I am just linking this from above. So this is coming from E33 and this is coming from E34. Now I select this cell, which is cell number B46, and I write enterprise value. Now remember, this is going to be in on the valuation date. Enterprise value as on the valuation date. The sum value. Now here let us also calculate the equity value. So let me just rename this enterprise value and equity value. Equity value as a header. So we will also calculate the equity value. Now from enterprise value getting up to equity value, we will have to make some adjustments in enterprise value. What are those adjustments? Let me show you. We are going to reduce the debt, or basically the current debt. We are going to add the cash and cash equivalents which the company is holding. We are going to reduce the NCI, non-controlling interest, which the company is not controlling right now. And we are going to add any joint ventures and associates. And finally, we are going to get equity value of the company. So I select this array, I hard code equity value. I select this array and I change this to subtotal. And this is going to be, the formula is going to be the sum of all these things, which is from E46 to E50. I close it up and we will have equity value. Let's make this necessary amendments as well. So let's get the debt value. So where we are going to get this is going to come from balance sheet. So I just go to balance sheet. I look at row number 18 and here we have total debt column. So we will have to look at the last debt which is available. So linking this to J18 and I press enter and make sure that this is in minus. So I multiply this with -1. We need to add cash and cash equivalents, which will again come from balance sheet. So I come to balance sheet, I go to the asset section, and in cell number J6, we have this cash and cash equivalents. I press enter, and here we have cash and cash equivalents. We'll have to reduce non-controlling interest. So once again, we go to balance sheet and we come to equity and liabilities side. And in row number 20, we have actually non-controlling interest. I select this cell, which is cell number J20, and I press enter. Because NCI needs to be negative, so I adjust the sign by multiplying this with -1. And finally, JVs and associates. If we look at the structured balance sheet, basically the group balance sheet, so we won't find JVs and associates. We will have to go down to the reported segment. So when we scroll down, and when we look at this row, which is row number 37, it says investments in associates and joint ventures. So we select the cell which is J37 for us and we press enter, and this is going to be in positive values. So that is why we have this. So that is why we are not going to change the sign. So here we have the equity value, which goes for all the equity owners of the company or equity holders of the company. So the next step is going to be calculation of equity value per share. So we will require number of outstanding shares. This is going to come from the input and calculation sheet. We come to input and calculation. If we look at cell number E27, here we have number of outstanding shares, and this is 24.1. Once again, I finally come to cell number B53. I hard code equity value per share, and in cell number E53, I select E51 divided by E52, this is going to give me equity value per share. I select this array from B53 to E53. I change the cell style to total, not subtotal, but total. Now, this is what we have, which is finally the equity value per share of the company, which we have calculated. Now, few more line items just for the sake of calculation. Current market price, we do an analysis and we write upside or downside. The current market price is going to again come from input and calculation. I come to this cell, I select this, I press enter. Here we have current market price. The analysis says that it is overvalued. Why is it so? Because if current market price is above the equity value per share calculated, then it will be called as overvalued. If we'll have to give a nested if, because if this is equals to the equity value per share, which is basically if the current market price is equals to the equity value per share, it will be called as fairly priced. If not, then it will be called as undervalued. The E53, which is if the current market price is above the equity value per share, then it will be overvalued. If it is below, then it will be undervalued. So let me give you an example. Imagine that if this would be trading at 3500, it is undervalued. Or if it is trading exactly at 4821.20, or let me say that this is exactly the same value 4860.5, then this is fairly priced. And it's very rare to happen that it will be precisely or exactly uh, fairly priced. The upside and downside is the final divided by the current market price, basically the equity value divided by current market price minus 1. And this is what the expectation has been, which is upside or downside. Okay, so this marks the completion of calculation of intrinsic value of the share. There are still some of the steps which are left out, which is going to be called as sensitivity analysis, scenario analysis, and kind of decorating this file so that it is more presentable to the user. So I hope you are clear up to this point. If you have any questions, drop that in the comment box. See you in the next video.